You start investing with big dreams to build wealth, and boom, your portfolio is in red within months. Frustrating, right? Well, not really. This is actually very normal, and it is even necessary for long-term success. Most investors enter the market at the worst possible time and unknowingly set themselves up for an early loss. And it is not bad luck. It's a pattern, a predictable cycle that keeps repeating. But here is the twist. If you understand this pattern, you can turn the early losses into future gains. In this video, I will show you why your investments start with a loss, how market tricks most investors, and most importantly, how to escape from this trap and use it to your advantage. By the end of this video, you will be able to invest better, stay ahead of cycles, and build wealth rather than getting caught in these losing cycles. Watch the full video because I will be revealing the Redbox trap that might change the way you invest forever. If you like content like this that are unique investing lessons, please consider liking this video, sharing it with your friends, and subscribing to this channel. Most investors enter during a bull phase when optimism is very high and markets naturally correct from there after a rally. Historical data shows markets don't grow in a straight line. There is often a pullback even during uptrends. Let us look at this chart about SIP stoppage trends. That is when investors stop investing. Investors exit at the worst time. In November 24, SIP stoppages rose very high, pushing the SIP stoppage ratio to the highest 79%. This is when the markets turn volatile. Similar spike occurred in May 20, that is COVID market crash. The SIP stoppage ratio hit 80% when investors panicked and halted their investment. This data proves whenever markets correct or turns volatile, investors stop investing, missing the chance to buy low and benefit from a future recovery. But more importantly, the opposite is true during the bull markets, meaning people invest most when the markets are at the peak. In May 2021, when markets peaked, the SIP stoppage ratio was very low, just 35%, meaning maximum investors were still investing as the rally made them feel very confident. Low SIP stoppage means investors pour more money into the market when the valuations are already very high and just before a correction. This pattern explains why most investors lose money, and this cycle repeats. Bull market, more SIP inflows, fewer stoppages. Market corrections, more SIP stoppages, fewer newer investments. This explains why most investors who start investing experience losses initially because they unknowingly enter at market peaks. In financial year 22, over 71% of mutual fund investments were redeemed within 2 years, and in 23, 73% of the units were redeemed within 2 years of investment. This short holding period means that investors are not giving their money enough time to recover from short-term market fluctuations. Less than 3% of investments lasted beyond 5 years, showing that very few investors stay invested long enough to benefit from the long-term wealth creation. This premature selling often happens after a deep market correction, meaning investors lock their losses instead of allowing time for a rebound. And this pattern proves that most investors enter at high valuations, panic when market drops, and they exit before they can see the real gains. This results in their investment starting with a loss. Key insights from these two charts is that most investors must accept that they will not get their timing right. They tend to enter during bull markets, often at peaks, only to see their portfolios decline as the market naturally starts correcting. This correction is a common cycle. It is not an exception. Therefore, investors must mentally prepare for short-term declines. Your portfolio will likely show nominal losses in the early years, but these are temporary and part of the market cycle. Second, resist the urge to exit during market correction. Panic selling locks the losses, while staying invested allows recovery and future gains. Third, commit to a longer investment horizon. Data shows that only a tiny fraction of investors stay invested for even 5 years. Yet, long-term patience is what is going to drive wealth creation. This is not a perfect charting, but can still explain the concept of the red box trap, a cycle where investors enter after a bull run, only to get caught in the red box, an inevitable correction and consolidation phase. When you look at the overall market movement, zoom out and you will see that it's a straight line growth chart. But when you zoom in, every major rally is followed by a red box phase lasting 2 or 3 years. Investors who enter at the peak panic, redeem early, and accept losses. This pattern repeats. 11 to 14, almost 3 years of stagnation. 2015 to 17, another 2 years of consolidation. Again, years 18 to 21, 2 to 3 years of sideways movement, and yet another extended period of correction. Most investors entering at the bull market peak soon enter into the red box. Red box is marked by the start of a correction, and investors mostly never escape their first red box experience because it can last for a couple of years and they sell very disappointed. But the real winners are those who are able to break free from one red box to the next, transcending instead of getting trapped in the short-term volatility of the box. So survive the red box, jump to the next box, repeat. So wealth is created outside this red box, between the red box. No one knows when this transition will happen, but what we know is that it happens after a long period of consolidation and corrections. So when we look into the red box, a few more insights emerge. This is a period of volatility. Market starts with a correction and keeps going up and down based on news flow and macroeconomic factors. This also denotes a period where one can actually acquire units, funds, in a staggered manner. It could be based on your own plan. It could be based on SIP, smart SIPs, valuation-based weekly STPs, or even one-time lump sum purchase based on your own valuation metrics. This is the period of behavioral finance. It means managing anxiety. An investor will be subjected to these 5 feelings, and the goal is to manage them. You can take help of a behavioral coach or a trusted sounding board. Sometimes an outside perspective can help you stay on track with this. In its research title, A Slow Start is a Good Start, an investor can expect a period of low returns in the initial investment journey of a long-term SIP. Historical data suggests that SIP investments have delivered lower returns in the initial 5 years, and such SIPs have delivered better returns on a 10-year average basis. This is because you're buying through a phase of correction and consolidation, and eventually when you get out of this red box, the market zooms. Please do let me know in the comment section your own experience of handling volatility, navigating through these red boxes, and your own learnings. I look forward to reading them and also learning from your views. The second part of this video deals with the behavioral finance part. Retail investors chase past returns. This increases probability of near-term correction. They enter at high valuations, that is high price to earnings or price to book value, reducing the expected future returns. This leads to temporary negative returns in the short term. Example, a Nifty PE about 25 historically has led to subpar returns in the next 1 or 2 years. Even in bull markets, short-term corrections of 10% is very common. Nifty has corrected by 10% on an average almost every year. So investors who enter during the peak will likely see red in the short term. So the market feels rigged against you because market fluctuates daily. Investors think that every time they invest, the market drops. But in reality, market rises 70% of the time in the long term. But short-term drops, therefore, feels very unfair. In closing, focus on the time in the market, not timing the market. Valuations at the time of entry matters. Shift focus from short-term losses to long-term wealth creation. Understand market psychology so you don't fall for early losses. Please consider liking this video, subscribing to this channel, and share it with your friends.